2023 costing question. So in 2023, this is the deferred paper, and it was on marginal costing and stock valuation. So part A, marginal costing. So McDonagh Limited produces a single product. The company's profit and loss account for the year ended 31st of the 12th, 2022, during which 90,000 units were produced and sold, was as follows. So you can see there they have 90,000 units in sales and then €1,080,000 in revenue there. Then you've got materials, 180,000, direct labour, 315,000, factory overheads, 260,000, admin expenses, 120,000, total cost there then 875,000, and then net profit 205,000. So the materials, direct labour and 50% of the factory overheads are variable costs. €70,000 of the administration expenses are fixed. So required. So you're required to find out 1, the break-even point and margin of safety for McDonagh Limited. Number 2, roughly sketch a graph showing McDonagh's break-even point and margin of safety as calculated in part 1. Number 3, the number of units that must be sold in 2023 if the company wishes to increase its net profit by 120,000, assuming the selling price and cost levels and percentages remain unchanged. Number 4, the selling price that must be charged in 2023 if fixed costs increase by 12% but the volume of sales and profit remains the same. And number 5, the profit the company would make in 2023 if a commission of 5% of sales is given to sales personnel, €1 extra per unit is spent on new packaging, the volume of sales increased to 95,000 units, and the selling price increases to €14 per unit. Now there's a part B to this question as well about stock valuation. So it says Doherty Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2022. So you've got different periods of the year. So the first 4 months of the year, second 4 months of the year, and then third 4 months of the year. So you've got purchases on credit, and you can see here that they are all for different amounts. And then you have credit sales and you have cash sales. Okay, so on the 1st of 1st, 2022, there was an opening stock of 5,500 units at €8 each. So what is required? So required, calculate the value of closing stock using the first in, first out FIFO method. Number 2, prepare a trading account for the year ended 31st of the 12th, 2022. And number 3, outline 2 implications of an incorrect stock valuation. Okay, so we're going to get stuck into part A first. Now what we have to do first, we have to complete a marginal costing statement, and you have to take great care at this stage. So what is a marginal costing statement? Well, it has to be done, okay, for every marginal costing question, and it is sales less variable costs, and that is equal to contribution, and then less fixed costs, and that is equal to net profit. Okay, so the sales here, okay, there's 90,000 units and €1,080,000 there. Now it says the materials, direct labour and 50% of the factory overheads are variable costs. So this is all variable, and then 50% of the factory overheads are variable. So 130,000 of the factory overheads are variable and 130,000 of them are fixed. And then it says 70,000 of the admin expenses are fixed. So that means that 50,000 of these will then therefore be variable as well. So this is what we're doing. So if you can have a look, direct materials 100% is variable, direct wages 100% is variable, factory overhead 50% of it is variable, and then 50% is fixed. Admin overhead then 50,000 is variable, 70,000 is fixed. So this is how we lay it out. We have our sales, 1,080, and we add up all of our variable costs, which is €675,000, and then that gives us a contribution of 405,000, right? So 1,080,000 minus 675 is equal to 405,000, and then we take away the fixed cost of 200,000, and then that is 205,000 euro net profit. So what we need to do at this stage as well is we have to work out what is it per unit. So 108,000 divided by 90,000 units is 12 euro selling price per unit. 675,000 euro, okay, divided by 90,000 units is €7.50 variable cost per unit. And then contribution 405,000 divided by 90,000 units is €4.50 contribution per unit. And then the 200,000 euro fixed cost, that's your total fixed cost. So that has to be done at the start of every single marginal costing statement question. When you have this done, everything else, you can do it really quickly. Okay, so we'll move on then and answer all the questions that they're asking us to do. So part one is asking us to calculate the break-even point and the margin of safety for McDonough Limited. Okay, so you need to know what the break-even formula is. So break-even formula, fixed costs divided by contribution per unit. So you can see here the fixed costs are 200,000 and you can see the contribution per unit is €4.50. So that is 44,444.44444 units. Now, you cannot sell 0.44 of a unit, and you have to break even. So you're going to have to round up to 44,445 units in order to actually hit the break-even point. So 44,445 units is the break-even point. Now, margin of safety then, that discusses how much your sales can drop before you'll start making a loss. Okay, so the sales there are 90,000 units, all right? So 90,000 units, and we're going to minus the 44,445 units that we needed to break even there in the last part. And so our sales can drop by 45,555 units before they will start making a loss. So again, that formula is very important that you learn that off. So it's just the sales minus the break-even point in units. Now we're going to take a look at what this looks like visually, okay, in the next part. So part two, we were asked to do the break-even point, right? So it showed the graph, okay, showing the break-even point and margin of safety. Now, here is the break-even point, okay? And you can see here that this is the output, the number of units here, and the break-even point there, 44,445 units, that is the break-even point when they have sold that amount, okay? That is the point where they have actually covered all of their costs, okay? And they've put here then as well that is 533,340 units, because that was multiplied by €12 per unit to get that, okay? It's 444,445 multiplied by €12 is 533,340. Now, the margin of safety, right? So here's the 90,000 units that is the maximum sales, okay? So the difference between the expected sales and the break even, that is the margin of safety. So sales can drop by that amount before they'll start making a loss. So margin of safety there, 45,555 units, okay? So the 90,000, that is the total revenue. You multiply that by 12, that's the figure that was given to us in the question. Now, we've a few other things here that we need to put in the graph. You can see here, this is the fixed costs, okay? So your fixed costs, they remain the same regardless of the output, okay? So it doesn't matter what the output is, all right? That is the fixed cost. Now, the variable costs start, the line starts where the fixed costs, is, right? So your total cost there, that's your fixed and your variable costs, okay? Your total revenue then starts at 0 and it just goes up, and then you can see wherever it cuts, that is the break-even point there, right? So there's 8 marks going for that part, okay? So 8 marks going for that part. I would say, labeling the cost and revenue, labeling the output, labeling the break-even, labeling the total revenue, labeling the total cost, the fixed cost. So that's 1, 2, 3, 4, 5, 6. And then I would say having the margin of safety, having the total costs and the break-even in numbers and the margin of safety labelled, etc. So there are a lot of marks going for that, but that's the height of it. It says roughly sketch a graph. You don't need graph paper. You don't have to be incredibly precise. You just need to bring in the figures from the question, okay, that you have completed, and then that is adequate then to getting the marks. So if you got your own incorrect figure, it's very likely that you're going to get the marks here, even if you get it wrong. Okay, so part 3 is saying calculate the number of units that must be sold in 2023 if the company wishes to increase its net profit by 120,000, assuming the selling price and cost levels and percentages remain unchanged. Okay, so this is sensitivity analysis. So what if analysis? What if we did this? What if we did that, right? What will the profit be? What would the impact of change in fixed cost be? What would the impact in change of selling price be? So that is sensitivity analysis, and this is what we're going to do now. So the scenario they've asked us for is, what would the number of units have to be sold in 2023 if they wish to increase their net profit from 205 by 120,000, so going up to 325, okay? But assuming that the selling price and cost levels and percentages and everything remain unchanged, okay? So what we need to do the formula like this. So sales less variable costs minus fixed costs is equal to profit, okay? So your sales, we don't know the number of units, but we do know that the selling prices remaining unchanged, okay? The variable costs are not changing, right? They're not changing from 750, but the number of units is changing. So we're just going to multiply €750 by X. And then the total cost, so the fixed cost, is going to be staying the same at 200,000. There's absolutely no change there. But the profit, they do want the profit to be 205 and 120, so 325, okay? So we'll work it out then down below. I think it's always a good idea to put all the changes up on top and then work it out down the bottom so that you won't, it just makes it nice and clear in your head, because these questions can get a wee bit messy. So you're going to have 12x minus 7.5x minus 200,000 is equal to 325,000. So what we're going to do now, we're going to get all the x's to one side and all the euros to the other side. So 12x minus 7.5x will leave us with 4.5x, and then we'll bring the 200,000 over, so we'll add that, and that'll become 525x. So then we're going to have x is equal to 116,667 units. Okay, so this is just like algebra, right? You're finding what is your x. In this question, the x is the number of units that have to be sold. And you just need to use your formula, sales minus variable cost minus fixed cost is equal to profit. Keep that formula and just do all the changes up above, and then work everything out down below. Okay, so that is it. Okay, so that's it. Okay, a lot of people, you can see it in marking schemes, you can see a lot of different ways of doing these things, but I just think sales minus variable costs minus fixed costs is equal to profit is the one that you should use. Okay, number 4 then, the selling price that must be charged in 2023 if fixed costs increase by 12% but the volume of sales and profit remain the same. Okay, so we're going to use the exact same formula. So what are we looking for here this time? This time they're looking for what's the selling price that must be charged. So what's the change is going to be? So the changes, the fixed costs are going to increase by 12, but the volume of sales and profit remains the same. So the volume of sales is staying at 90 and the profit is staying at 205. Okay, so let's have a look at how these things will be affected. So the selling price we don't know, but the volume of sales will stay at the 90. Now the variable costs, right? Variable costs per unit there, 750. Okay, so it's just going to be our 90,000 units by 750. Fixed costs, so my 200,000 is going to be increased by 12%. So we're just going to multiply 200,000 by 112%. And then the profit is staying the same at 205,000. So we're going to have 90,000x minus 675,000 euro minus 224,000 euro fixed costs is equal to profit of 205,000 euro. So we're going to have 90,000x is equal to 205 plus the 675 and plus the 224. Okay, so 90,000x is equal to 1,104,000. Therefore, selling price is 12.25 euros. So €12.27 per euro would have to be the selling price that must be charged if the fixed costs increase by 12%, but the volume of sales and profit remain the same. So that is the answer there to part 4. And typically something like that would be about, 8, 10, 12 marks, all right? But again, it's just algebra. Lay it out nice and neat, okay? Workings up on top, changes up on top, workings down below, and just write out your sales minus variable cost minus fixed costs equal to profit. Make that very clear. Okay, next one, part 5. The profit the company would make in 2023 if a commission of 5% of sales is given to sales personnel, €1 extra per unit is spent on new packaging, the volume of sales increase to 95,000 units, and the selling price increases to €14 per unit. Okay, so again, same formula. Okay, now the selling price increases to €14 per unit and the volume of sales increases to 95,000 units. So that's what I'm seeing here for my first part, the sales. So the number of units, 95,000, selling price, €14. Now variable cost. So my variable cost, right, is 750 up here, but they're telling us two things about variable cost changing here. They want a commission of 5% of sales given to sales personnel, okay, and they want €1 extra per unit spent on new packaging. So they are both variable costs. Now, the commission of 5% of sales. 5% of sales is going to be based on the selling price of €14 per unit, okay? So 14 multiplied by 5%, it's going to be 70 cent commission for every unit, okay? So every unit gets a commission of 70 cent, and that is just €14 per unit selling price multiplied by 5% commission, 70 cent. Then you've got the 95,000 multiplied by the €1 on the new packaging, and then you've got the 95,000 by the 750 variable cost up here. Now, no change to fixed costs, okay? It's no change in that list of changes that were to be made, and profit is what we're looking for. So profit is going to be the X. So all we're going to do now, we're going to multiply everything out. So 95,000 by €14 is 1.33 million. Multiply all the variable costs out, and when you put them all into the calculator, you're going to get 874,000, and then the fixed costs are 200,000, and then that is equal to profit. So profit is equal to €256,000. That is the profit. Okay. Now, on to part B of the question, which is the stock valuation. So FIFO stock valuation. So Doherty Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2022. So here we've got the first period, the 1st, 2022, the second period, the third period. So we've got 4 months, right? Each period is 4 months here. So in the first 4 months, there's your purchases on credit, there's your credit sales, there's your cash sales. Second 4 months then, the exact same thing. Third 4 months, the same thing again. Now, you will notice that they are purchasing, so it's only one product that they're purchasing and selling, but you're noticing that they're purchasing them in different amounts. and for different prices each time. And it's the same with the credit sales and the cash sales. So different amounts and different figures, okay? Now, on the 1st of the 1st, 2022, there was an opening stock of 5,500 units at €8 each. So what is required here? So required, part 1, calculate the value of closing stock using the first in, first out FIFO method. So calculate the value of closing stock using first in, first out FIFO method. Okay, first in, first out means the units that I've bought first, I'm going to sell first. So they would be selling these ones first, okay? And then once they've sold them, they'll now sell the next amount of purchases, and then the last. So the things that they bought last, they're going to sell them last. The things they bought first, they're going to sell them first. So first in, first out. It's like the grocery shops buying milk and selling the oldest milk first. So they're bringing the oldest milk out to the front of the shelf, okay, and selling them first. Right, so calculate the value of closing stock using first in, first out method. Okay, so what we're going to do, before we calculate the value of the closing stock, we need to, find out, right, well, how many units of closing stock do I actually have left, okay? So what we're going to do, we're going to take a look at the opening stock. So we want to imagine how many units of closing stock we're going to have left at the end of the year. And you can imagine the opening stock then, they're obviously going to sell that first. Then we're going to look at the purchases. So how many units have they purchased during the year? Because that 5,500 at the start of the year in the warehouse, we're going to add the 11,400 then onto that, okay? Because then we have all of that in the warehouse. Now, what will leave the warehouse then is all the sales. So when we add all of those figures together, all of those number of units together there, that is 11,800, okay? So therefore, we're going to have a closing stock of 5,100 units. So that's how much we have the units of closing stock, okay? What we're going to have to do is calculate the value of that now. So what is the euro value on those units? So obviously, as we said, we have to use the first in, first out method. So we are going to have all of these still left in the warehouse because there's 5,100 left. And so all of those 3,500 that were bought last are still there. Okay, so that's obviously €35,000. Then that leaves us with 1,600. So we've got 1,600 of these left. So 3,100. So 1,600 at €8 each is 12,800. And so therefore, when we add all that up, we've got €47,800. Okay, so €47,800. That is the value of the closing stock using the first in, first out method. Okay, so €47,800. Now, part 2, prepare a trading account for the year. Okay, so a trading account, let's remember our closing stock here, 47,800. So trading account is basically just sales, less cost of sales. Opening stock plus purchases, less closing stock. That's going to be your cost of sales. Take that away from sales, and that's your gross profit figure. So our sales, what you're going to do, you're going to spend a hell of a lot of time on the calculator, and you're going to punch into your calculator 1,400 multiplied by 10 plus 2,600 multiplied by 11 plus 1,700 multiplied by 12 plus 17,000 multiplied by 12 plus 2,500 multiplied by 10 plus 19,000 multiplied by 11. And that's going to give us an amount of €129,300. Then we're going to take away our cost of sales. So first we've got our opening stock, 5,500 by €8 each, and that is an opening stock of €44,000. Then we're going to work out our purchases. So 4,800 at €9 each, plus 3,100 at €8 each, plus 3,500 at €10 each. And that is €103,000. Then we're taking away our closing stock, okay, which was €47,800. That gives us 99,200 and gives us a gross profit of 30,100, and that is part 2 completed then. Now, part 3 is a little bit of a theory question before the question is completely finished, and it says outline 2 implications of an incorrect stock valuation. So 2 implications of an incorrect stock valuation. Okay, so what happens if you value closing stock incorrectly, right? So incorrect valuation of closing stock affects the financial statements of 2 years or 2 accounting periods, i.e. the closing stock of one accounting period and the opening stock of the next accounting period. So if you think about it, you've got a closing stock in your TPL, which is going to be your opening stock in your next year's TPL. So your figures are going to be wrong for 2 whole years. The figures for cost of sales, gross profit, net profit, and subsequent figures in the balance sheet are all going to be wrong because your closing stock figure is wrong. In the balance sheet, it's going to affect your figure for current assets because your closing stock is in current assets, and working capital. So they're all going to be wrong because your closing stock figure is wrong. In carrying out ratio analysis, the figure for stock will affect the stock turnover, percentage markup on cost, gross profit percentage, net profit percentage, and the current ratio. So the closing stock is used in all of those calculations. So it's going to be wrong. All of those ratios are going to be wrong if the closing stock is wrong. The opinion of the firm in financial circles, its tax liability, its ability to borrow, public opinion, and consequently its share price. So basically it's going to, like, the company's going to be a bit of a laughing stock, because if a company cannot value their closing stock correctly, there's going to be no respect for it in the financial circles. They're not going to be calculating their tax liability correctly. So if they don't have their closing stock right, their profit figure is not right. Therefore, the amount of tax that they're calculating that they need to pay will be wrong as well. And that will have huge knock-on effects. So, other companies in circles and the public opinion, and if it's on the stock exchange, etc., it's just not going to be good for that company. So the markup on cost in an industry provides a valuable measure for any firm in that industry. So a markup that is out of line with the norm is a cause for concern and should lead to immediate investigation to locate the reason and take remedial action. So stock turnover determines the total volume of profit. Therefore, the higher the better. So that is your 2023 deferred costing question complete.